Hey traders! Welcome to another episode of the Smart Money Trading Channel. Today, we're delving into a cornerstone trading plan of smart money concepts, using the powerful tool of change of character. For many traders, setting up trades based on the change of character can be challenging, risking their trade simply because they might not be familiar with the key points and tips we're about to share in this episode. We'll not only share essential tips but also reveal precisely how and where to enter and exit a change of character trade with an optimized strategy. So, if you're interested, give this video a thumbs up and subscribe to our channel if you're new. Now, let's dive in. Welcome back, traders. Let's start by discussing smart money concepts classification of entry methods into two major categories, reversal and continuation entry methods. Reversal entry includes change of character and flips entry methods. We've thoroughly covered all the criteria and rules needed to identify a valid change of character in the market in previous episodes. Now, let's put all that knowledge together and understand how to leverage these concepts to our advantage and establish a trading plan based on the change of character. Firstly, we conduct market structure mapping on the 4-hour time frame and highlight unmitigated areas of interest. We then shift to the 15-minute time frame to gain a clearer perspective on price action and search for any signs of a change of character in market behavior. If the price forms a 15-minute time frame change of character pattern, we proceed to zoom into the 1-minute time frame to search for any signs of a change of character. After fulfilling all the mentioned criteria, we proceed to the last step, setting up an entry on the 1-minute time frame. Now, let's delve into the details of each step. Imagine we have a 4-hour structure where price is in a downtrend and has created a series of bearish moves. We identify an unmitigated supply zone at the extreme. If we have a perfect sell setup on the 4-hour time frame, confirmed by the criteria and rules of a high probability trading setup, our next step is to switch to the 15-minute time frame and closely monitor price movement. After detecting confirmation for market structure shift in the 15-minute time frame, we apply our trading plan. We identify and highlight the supply zone generated by the change of character's bearish wave on the 15-minute time frame, then zoom into the 1-minute time frame and patiently wait for the price to tap into the identified 15-minute time frame supply zone to get reversed from it and create a new change of character on the 1-minute time frame. Once the change of character is confirmed on the 1-minute time frame, our next course of action is to identify the order block generated by the change's wave in the 1-minute time frame. Subsequently, we place a sell limit order at the lowest point of the zone with a stop loss set a few pips above the highest point of the zone. As for the take profit, we have the option to target the unmitigated demand zone on the higher time frame or the swing low of the current time frame. If you miss the change of character or if the price action doesn't provide an opportunity to enter the market, then taking the continuation trade becomes the easiest and safest way to execute trades. Here, you're either executing additional positions or entering the market after a mitigation of a supply zone, aiming to fill inefficiency left behind and then tapping into the supply zone situated at the extreme. To execute continuation trades, certain criteria must be considered. The price must form a change of character pattern. Patiently await a break of structure and zone breakout in the price movement. Ensure that the price leaves inefficiency behind when forming a break of structure. And confirm the presence of static liquidity zones near the identified point of interest. In summary, executing a continuation trade requires that all these rules and criteria are met. Once they are, we can proceed to place our limit order at the lowest point of the supply zone with a stop loss above the highest point of the area and set our take profit target accordingly. Let's look at another example in this field. In this example, the market structure in the 4-hour time frame is bullish. And we see upward movements in the chart. We look for the demand area and specify it. Then we go to the 15-minute time frame and wait for the price to enter the demand zone. Then, in 15 minutes, after observing the change in the character of the corresponding area, which caused the change of character and upward movement, we will draw as one area. Then we go to the time frame of 1 minute and place our order in this zone. We place stop plus above the zone and TP in recent swings. Now, let's look at some real chart examples to see how these trade setups play out. On the 4-hour time frame, we see that the market's overall direction is bullish. After sweeping the sell-side liquidity accumulated below equal lows, the price drastically pushes to the upside, breaking through the latest major high and creating a bullish break of structure with great inefficiency. Eventually, all 3 trades hit the take-profit target. Thank you for watching. We hope you found this video informative and useful. Don't forget to subscribe to our channel and leave your feedback in the comments below. See you in the next episode.